In this video clip, we start to look at the calculation of the NCI, and we're still using question 1812 for our calculations. Now, before we start with the calculation, just to recap again what or who the NCI are. Now, the majority of the consolidation questions we've covered had a group structure where the parent owned 100% of the shares in the subsidiary. Now, as soon as the parent does not own all the shares, but for example owns 80%, it implies that there are another 20% of the shares which are held by other shareholders. So the non-controlling interest is basically those other shareholders, and they are classified as equity or capital contributors to the group. So even though they hold the shares in the subsidiary, from a group perspective they are viewed as a capital contributor to the group. We value or calculate the NCI based on the equity in the subsidiary that is not attributable directly to the parent, and that is allocated to the NCI. Because they are a capital contributor to the group, their equity is still going to exist in the consolidated financial statements. So therefore we see that the aim of the NCI adjustments are to extract, just get the spelling there right, extract the NCI share of the subsidiary's equity, and we extract it from the retained earnings or share capital or whatever capital equity account, and we disclose it separately as non-controlling interest. From the other consolidation entries, you know, of course, what happens to the parent share in the subsidiary. The consolidation entries aims to eliminate their share, so that in the end we sit with the parent's equity and the NCI share of the subsidiary's equity disclosed on a one-line item. Now, in a previous slide, I've also mentioned that with regards to the parent share of the equity of the subsidiary, we split the equity between pre-acquisition equity, in which case adjustments that affect this are made in the pre-acquisition equity entries, and then post-acquisition equity, where we make the adjustments in the current year or against opening retained earnings. But for NCIs, we don't have the split pre-acquisition and post-acquisition. We actually follow a three-step approach to calculate it, and we look at the timing of the transaction. So we deal with a transaction in the financial year that it applies to. Okay, so what do I mean by that? Let's look at calculating the NCI for question 1812, and you'll see the three steps that we follow. Okay, so if this is the acquisition date, we split the NCI calculation in three stages. So step 1 covers their share of the equity that is recorded at acquisition date. Step 2 covers the period since acquisition date until the beginning of the current financial year. And step 3 then covers the current year, which is from the beginning of this financial year till the end of the financial year. And step 3, you can almost split in an A and a B So in this video clip we're going to do the calculation step 1, step 2 and step 3a, if you have it like that. Step B we'll cover in the last video clip on this question. So step A deals with the profit for the year, movement in reserve accounts, where step B looks at the NCI adjustment on intragroup consolidation adjustments. Okay, so that we'll cover in the next video clip. Okay, so let's look at step 1. Now in step 1 we calculate the NCI share of the equity recorded at acquisition date. So similar principle to calculating the parent share of the subsidiary's equity at acquisition date, we take the equity that existed in the subsidiary on acquisition, so their retained earnings, which was 50,000, the share capital of 200,000, the asset revaluation surplus of 50,000, and then the BCVR that was created as part of our first step of the consolidation process to show the assets and the liabilities of the subsidiary at fair value. In this solution, the goodwill attributable to the NCI has been split out, but it can be combined all in the BCVR line item, or the goodwill can be treated separately. Either way, it doesn't really matter how you do the adjustment. Now this entry, the NCI share of equity at acquisition date, is drawn up once and then never adjusted again. So in all subsequent consolidation worksheets, as long as the group structure looks the way it is currently, this entry will be passed, as opposed to the parent pre-acquisition equity entry that is adjusted for any consolidation entries that affect pre-acquisition equity. So can you see the difference there? So for the parent company, it's important to know whether it's pre-acquisition equity or post-acquisition equity. For the NCI calculation, we just want to know at what stage the entry occurred, and we follow the timing of the entry. Okay, so we draw this entry up once, taking the NCI share of the subsidiary's equity on acquisition date, and then we don't eliminate it, we extract it from these line items in the consolidated financial statements and disclose it as one item NCI. So that is the first part of our NCI calculation. And in the balance sheet, we'll have an account NCI, which represents their share of the group's equity. As you can see, the total of that agrees then to the fair value of the NCI at acquisition date. The second step in our NCI calculation then covers the period since acquisition date until the beginning of the current financial year end. And in this step, we calculate the NCI share of the change in equity from this acquisition date until the beginning of the current period. So our starting point is first of all to see what happened in retained earnings in this period. Now we know at acquisition the retained earnings was $50,000, and in the question they told us that the retained earnings at the beginning of the current year was $60,000. So we start off with the earnings over this period of $10,000. Okay, so that's the first part of the calculation. The subsequent adjustments that we have to take into account in this calculation all originates from the BCVR entries. So if you turn back to the BCVR entries that we've passed at the end of this financial year, all the depreciation charges and tax effect that was included as adjustments against the retained earnings opening balance. Let me see if I can maybe get a clip just to show you that. Okay, this is the BCVR entries that we passed relating to the plant and machinery. First of all, the plant and machinery that we still owned and the one that was sold. So if you look at the BCVR entries that we've passed in the current consolidation worksheet, year after these entries, so the entries that affect the opening retained earnings, because this relates to adjustments to the earnings of the subsidiary in the period since acquisition until the beginning of the current financial year. So these amounts need to be adjusted against the earnings that we used as a starting point, such as the increase and the net increase in the retained earnings balance. So let's go back to the previous slide. So this is the depreciation on the machinery that we still own for the, years 1 and 2, and the tax effect on that. This is the depreciation relating to years 1 and 2 for the machinery that was sold in the current year, and the depreciation and the tax effect of the vehicles for years 1 and 2. Okay, so that is adjusted against the earnings for that period, and then the NCI share of that change in equity is 20%. So we extract it from the retained earnings and disclose it as NCI. So you can almost split out this entry in two if it makes more sense. So we'll have our debit retained earnings opening balance, 1020, credit NCI 1020. The other thing that occurred in this period that affects the earnings of the subsidiary was the inventory that was sold in year 1. So somewhere here the inventory was sold. When the inventory is sold, the entry is to reduce the NCI share of the BCVR, because that inventory, the profit from the sale of the inventory, is now realized and recorded in the subsidiaries' results for this period. So the NCI will receive their part of the profit through the adjustment in the earnings. So the NCI share of the BCVR should reduce as the BCVR reduces. So the entry would be, what was it? I think the BCVR was 3,500 on the inventory. The NCI share is 20%. So it's going to be debit NCI and credit the BCVR of 700. Is that going to have the effect? Yes, so this is now combined in one journal entry. So the retained earnings is extracted and disclosed as the NCI. The NCI also reduces with the BCVR that's transferred to the retained earnings, but only the 20% of the 3.5 that relates to the inventory. One other comment that I just want to make here is, see what happens with the NCI and the movement in the equity balance. So for this period covered in step 2, the retained earnings increased by this amount for the subsidiary on consolidation now. So we just work with the effect on consolidation, not the realized results that flows through from the accounting records, only the effect of the consolidation entries. Okay, so the retained earnings increases, so it's an equity account that increases, and if that increases, the NCI, which is the other shareholder's share of the equity, should increase as well. So that's why the NCI always moves with what happens in the equity balances. So the retained earnings increases, therefore the NCI needs to increase. So we extract it from retained earnings and reclassify it as NCI. In the third step of the NCI calculation, we calculate the NCI share of the change in the equity in the current period. So we now cover the period since the beginning of this financial year up to the date when we actually do the prepare the consolidation worksheet. Now, as I mentioned previously, this step I want to split in two parts. Part A, that basically covers the profit of the subsidiary for this year and other movements in the equity balances. The B part, which I'll cover in the next video clip, is the NCI effect of intergroup transactions. Okay. And my recommendation is really, when you do the consolidation questions and you're faced with an integrated question like this, is to attempt it in the different steps. So first of all, do the acquisition analysis, then the pre-acquisition equity consisting of the BCVR and the pre-acquisition equity entries of the parent company. Then start off with the NCI calculation, the step 1, step 2, step 3A, and then deal lastly with the intergroup transactions and their NCI effect. Okay, so let's see what's included in this A section of steps 3. Now the first part is to see what the NCI share is in the profit recorded by the subsidiary in the current year. Now, what is the profit figure or the earnings figure that we use to calculate their share of the profit? First of all, in this question, they told us that the total comprehensive income of the subsidiary was $28,000, and it included an asset revaluation surplus. So the profit from operating activities is then $25,000, and to that earnings we have to adjust for the BCVR entries, so the extra depreciation after tax, I can't remember the entries now. Let me just quickly go back to that slide. So for the plant and machinery, it was depreciation after tax. Oh yes, and then the machinery that was sold in the current year. So that extra depreciation for the 6 months and the loss after tax. Okay, so this was the depreciation after tax on the machinery that's still owned. The undepreciated amount that was written off, and the depreciation for the 6 months after tax, and this is the vehicle extra depreciation on a group level after tax. So we adjust that against the profit figure for the subsidiary. The reason why the depreciation adjustments are made against the profit of the subsidiary is to avoid double counting that's caused by the subsidiary that's recording profits in the current year from the use of the machinery and the vehicles, and the usage of those assets, of course, are reflected in the depreciation. So the subsidiary recognizes the higher benefits from consuming or using these assets in line with the depreciation, where the group basically recognizes the higher profits in our fair value adjustments that creates the BCVR. So we need to adjust for it here because we also record the NCI share in the BCV or at acquisition date. Remember, in that step 1 calculation, we've calculated the NCI share of the BCVR. So if we don't adjust for the subsequent higher depreciation, we're basically going to double account for those benefits of the higher value asset. Okay, the second adjustment in the current period relates then to the 3,000 asset revaluation that occurred. If I remember correctly, it was land that was revalued. But in any case, remember that the NCI has to move in line with what happens in the equity accounts. So in this case, the first entry, if you just look again, the profit or the subsidiary recorded a profit for the year, so their earnings for the year increased. So we extract a portion of that higher profit and disclose it as NCI, the portion that's attributable to the other shareholders. Similarly, the asset revaluation surplus increased for the year by $3,000, so we extract 20% of the $3,000, which relates to the NCI, and disclose that separately in the NCI line item. Because with the NCI adjustments we follow the timing of the transaction, we also have to record here the transfer from BCVR to retained earnings relating to the machinery that was sold during the year. Now remember, the parent share is dealt with in the pre-acquisition entries. So there was a similar entry, but for 80% of the 2,100 after-tax fair value adjustment for the machinery, and then the balance of that relates to the NCI share needs to be included as part of this step in our NCI calculation. The next entry that relates to the asset revaluation surplus, the 10,000 that was transferred to retained earnings. So once again, this follows the same direction as the entry that we've passed for the parent company, but this is only the NCI's share of that asset revaluation. Now both these entries for the parent company, in terms of the timing, was adjusted to this entry, the pre-acquisition equity entry. But for the NCI, because we don't adjust this step 1 entry but adjust it when the actual transaction occurs, these entries are passed in the current year. Okay, so even though they relate to pre-acquisition equity, they're being passed in the current year. Then the general reserve, the effect of that is basically 2 entries that were combined into one. So let's split them out quickly to make it more clear. So what happened is that $20,000 was transferred from the question here in front of me quickly, from retained earnings to the general reserve. So in the subsidiaries accounting records, there would have been an entry: debit retained earnings, credit general reserve. And the effect of that would have been to reduce our retained earnings and increase our general reserve. So it's just a reclassification between two equity accounts. The effect on the NCI is, because the retained earning has decreased, our NCI subsequently has to decrease in line with that movement in that equity account balance. So the one leg to this combined journal then is to debit our NCI, to reduce it with a transfer, and credit our retained earnings. The other leg is that the general reserve of the subsidiary has increased by $20,000. So the effect is that the NCI should increase in line with that movement in this specific equity balance. So we would extract 20% of the movement in the general reserve, so that is $4,000, extracted from the general reserve and increase our NCI with that amount. Now this entry is just combined here, so the net effect on the NCI will be 0. We just record that reclassification of earnings to the general reserve. Okay, so if it makes more sense to you, split out the entry to understand or to see that if there's an increase in an equity account balance, the NCI is going to have a similar increase by extracting it from that equity balance and moving it to the NCI. The last entries in this section relates to dividend that was paid and declared to the NCI. Now, when dividends are paid or declared, it reduces the equity of the shareholders, and what they receive as compensation for that reduction in their share of the equity is, of course, the cash when the dividends are paid. So when dividends are paid or declared, we'll see that the NCI is going to be reduced by those dividends that were paid or declared. So in this case, it was 20% of the dividends that were paid in the current year, and then 20% of the dividend declared, which was $8,000. Okay, so you can see then which entries make up Part A to Step 3. So Step 3, calculating the NCI share of changes in any equity balances of the subsidiary in the current financial year, where the A part really relates just to the profit that was made during the year adjusted for that higher depreciation on a group level, and then of course all the movements in the reserve accounts and other equity accounts, as well as transfers from the BCVR if one of the assets that existed at acquisition and was revalued has been sold or fully depreciated, as well as dealing with dividends that are paid and declared. Okay, so that's then the end of this video clip. In the last video clip on this question, I'm going to cover the intergroup transactions Not really looking at those transactions in detail, more the effect of that on the NCI.